Okay, so it looks like a few of you are a little bit confused with the Amazon put option case study, and that's not uncommon because it's a lot of people can't get with the idea, as I mentioned, a lot of people can't get with the idea that you actually can make money while a stock is declining. So let me break it down a bit. We'll go through it again a little bit slowly and talk a bit more about the actual position that we did. So Amazon, we looked at it and steadily rose for a while, and the trade that we did was this month, earlier in October, and we were looking at the stock chart and we noticed that it was coming up to what we call resistance, which acts like a ceiling, where the stock may stop going in the direction that it's going. So in this case, it's rising. However, we identified a level of resistance, a level of a ceiling, and we did that by looking at the chart, the technical analysis. I won't go into the detail of the technical analysis that's fully documented in the material that you have access to.
Who's actually looking at this? You and your broker?
So I'm looking at it as not the broker, me, because I'm the one that's making a decision on this trade. So I'm analysing Amazon and trying to work out if I can see where it's going to go next. So what we had found was that we're expecting. You never know exactly where it's going to go. You put forward a theory, a prognosis, and then you build a trade plan and you manage your risk. So that's and we'll talk a little bit more about the technical analysis a little bit later after lunch maybe. We'll get into a bit more detail. Now, once we've identified this level of resistance, we monitored the position and we started to see Amazon to drop. So we were, I guess, right in our prognosis, in our assessment, in identifying this level of resistance, which, the ceiling at the top. And this was at around about when Amazon was about 344. And you can see that again, it's a trade that we did in this month, October, and we have this document for you in the material you have access to. So when the stock broke a couple more levels, it was around 322. For us, that was a bit more confirmation that we were right in our thinking. We then analysed the stock a little bit more to put forward a target to the downside. So again, that technical detail will be discussed later after lunch, but it's also available in your material there. So we had said that, okay, our target for Amazon is down at 288 from 322, so roughly a $34 move to the downside. So with that in mind, we purchased a 310 put, as I mentioned earlier, the 310 put, which is a little bit lower than where the stock is today. That's fine. You can buy different put options at different what is the really called strike price. It's just like when you buy your house insurance or your car insurance, you will talk with your insurance provider and say, you want it at market value, or you want to insure your house for a certain price. So we've essentially insured Amazon at 310.
So who decided the actual name 310?
So there's when we look at the options, there's a table of all the different options that are available. And you'll have options that you can buy at 310, at 305, at 300, at 290, even above at 315, at 320. Now, the options all have different prices. They all have different expiry periods. Just like your insurance, you can buy insurance for 1 year, or for 2 years, or for 3 years, and you can decide which level of insurance you want to buy. Market value, or you decide a particular price that you want to insure your house for, or your car for. In the same way, there's a list of different options available. We purchased the 310 put. The reasoning behind that we'll go into later, but to keep the example simplified, we chose that particular put for a particular reason. and we paid $975 for that. Now, we'll just round that up to 1,000. So let's say we paid $1,000 for that. One put option contract controlled 100 shares, okay? So now, as the stock moved down, and in our case, the position actually hit its target right on the dot, and it took roughly around about 2 weeks to hit that target. So we held on the position for about 2 weeks. Again, it's all in your material, so we'll have a read of it, fully documented in a lot of detail. So what we did once we reached 288, what that meant was that we had a put option on Amazon that said we can now sell Amazon at $310. Now you think about that. Amazon right now is down here at 288. So we can use that piece of paper, that contract, and sell Amazon at $310, even though Amazon is at 288. Now we don't hold Amazon shares, so we're not going to sell the shares at that price. What we do is we actually trade the option. We bought the option, we paid $1,000 for it. Now that Amazon has dropped, which is in line with our prognosis, the value of this put option has increased. And logically, you can see that there's actually real value in that, because you've got something that says you can sell Amazon at $310 and Amazon right now is $288. Okay? Now the difference between that, if you look at that, the difference between what you can sell Amazon for and what Amazon right now is $22. Okay? Now because a put option contract controls 100 shares, therefore that value of that position is actually $2,200 right now. So what that means is that same put, the 310 put, which we purchased for $1,000, is now worth $2,200 because there's $22 of value in that put option, because Amazon has now dropped $22. Okay? Does that make sense so far? So what that means is we are able to therefore make at least or greater than 100% return on investment, as I mentioned earlier, because we purchased something for $1,000. As the stock went down to our targets, the value of that put option increased such that we were able to make a greater than 100% return on investment in only a couple of months. Okay?